The Quantum Group USA, LLC in California, DBA Quantum Distribution and Insurance Services. Advisors are responsible for following all insurance, DOL, FINRA, SEC, broker-dealer, and compliance officer approval requirements prior to distributing this information to clients. Welcome back to More Market Insights, our podcast interview with the Oracle of Scottsdale. It's Andy Moore, Quantum's Vice President of Advanced Planning and Portfolio Solutions. And today we're talking about what the Fed's latest decision is, the bond market, and July's market performance could mean for investors and financial professionals. So Andy, we know the bond market often adjusts to economic expectations long before the Fed changes policy. The Fed held rates steady, and yet the yield curve steepened. Is the bond market sort of disagreeing with the Fed right now? What's going on here?
Absolutely.
Okay.
So as expected, the Fed held rates. Actually going into the meeting Tuesday, Wednesday last week, the odds of that rate increase here in July actually increased to about a third. So some people did think that the Fed may raise rates with where inflation has been, but ultimately Kevin Warsh held his ground. There's 3 dissents. Ironically, though, we had the 10-year and the 30-year moved at their highest levels since 2007, which is, it's over the last 5 months, the 10-year is going from, call it a 4.2, 4.25 to 4.75. It's a pretty big move for the bond market. And then the 30-year hit 5.3. So you think about the cost of home ownership and 30-year mortgages. Ironically, I'm going through it right now. My son lives in Ocean City, Maryland. We bought a townhouse back in February, paid cash for it, quick sale. Since then, for me to refinance and pull that money out, it's about an extra $100 a month. And over time, it's a lot of money. So the bond market's supposed to be the smartest money on Wall Street. So it's telling you something that's out there. The Fed, when you look at projections, they don't meet in August. August is an off month for them. They're now looking at about a 2/3 chance that they raise in September. Last month, you and I talked. I didn't think it'd be until after the midterms. The Fed typically doesn't like to do anything right before elections, but the market says that the Fed probably needs to raise 50 basis points, maybe 75. And why is that? Because you look at the 2-year Treasury. 2-year Treasury sitting at 4.25. The Fed right now is about 3.5 to 3.75 on the Fed funds rate. So if you look at the 2-year and where the Fed's at, you probably see some rate increases. Ironically, though, with the 10-year and the 30-year, even the 2-year moving higher, that's a little bit of tightening in itself. It slows the economy down a little bit. At some point, at what yield does it affect the equity markets? We had kind of a flash crash, kind of that capitulation on Wednesday when the Fed didn't do anything and Warsh had some statements. We've been up Thursday, Friday. This morning we're up another 1.5%. S&P's almost back to the new highs. After a nice pullback. The Nasdaq hit correction territory last week. That's struggling a little bit, even though Mag 7's coming back. But to your question, the bond market's telling a whole different story than what the Fed's doing right now.
Not uncommon, too. And so a strong, speaking of equities, a strong month for equities in July. Broader participation, equal weighted index is outperforming. This is an indication of market breadth. It's wider now. Why is that so important?
Yeah, we've been talking about this for 3-4 months, right? So even going back to last year when software stocks sold off, went into a bear market, you kind of had the semi step up. July was actually kind of a flat month for S&P, Dow. Nasdaq was down about 4%, so a little bit of digestion, so to say, after a really strong second quarter that we saw. But when you look at what's going on underneath the hood, 85% of stocks beat their earnings estimates this quarter. When you look at the overall market, even though we had a flat market, about 60% of the stocks were actually up this past month. So when you're looking at the market, financials, healthcare, small caps, have all done really well, while technology has kind of taken a break. And I just alluded to, when you look at the Mag 7, even though Apple was down 10% on Friday after their earnings report, Microsoft has finally broken out. Meta had a really bad sell-off, about 10% on their earnings. They've bounced back about 5%. So you have the Mag 7. Amazon is another one. Google's off the lows. So you kind of see that rotation right now going back into big tech. We'll see if it lasts. See what the next couple weeks do. But the rotation to your original question, underneath the hood, the breadth's really good for a continuation of the bull market. It's actually equal weighted S&P has hit new highs, while the rest of the market is kind of taking a break. So it's really, the breadth for the market's really healthy for continuation to new highs going into the end of the year. Doesn't mean we won't have a hiccup. August, September, October, which I still think you see a good correction coming for midterms. We'll see if crystal ball's not less foggy, so to say, and crystal clear. But it sets up for a really good end of the year in 2027, which third year of a presidential term is always the best. So we could be setting up for a run north of 8,000.
And despite higher interest rates, looking back at corporate earnings, I mean, they're pretty resilient right now. I mean, let's look under the hood even deeper. What is really driving that strength, and what should investors and advisors be watching there?
So it's really been the CapEx spending. I think we talked about it last time with what the big tech is spending on infrastructure for the AI rollout. It's really impressive. It's larger than some of the biggest GDPs that are out there. So when you look at how that's going to broaden the economy, consumers still really strong, labor markets still resilient. So when you look at it, there's a lot of underlying factors that are really helping the market move higher.
As we talked about, this rotation in market leadership, I mean, is it simply a healthier bull market just kind of broadening out, or is this really the beginning of a more kind of a lasting leadership shift? I mean, because I know everything changes week to week, right? Yeah. We never know, but do you think this is an indication of that?
For the time being, I think it is. Who would have thought that the market would still be close to new highs within 3 to 5% when you had, back fourth quarter last year, software stocks, use Microsoft for example, Oracle, down 40 to 60%. Then all of a sudden we have the other Mag 7s, Google down $100, Amazon down, Meta down, and the market's still continuing to move higher on a larger scale, so to say, especially the equal weighted S&P. And if you look at valuation as well, and we've talked about this for the last 3 or 4 months. When you look at valuation going into 2027, S&P earnings estimates is about 400. We just had another quarter where earnings were up 25%. I actually think you're going to see that earnings estimate go to about 410 to 4.25 by the end of the year going into 2027. That puts us at a really good valuation for the S&P 500. Again, there's going to be some hiccups. We may see some pain going into the elections, in my opinion, especially if interest rates don't come down. They continue to move higher. If the 10-year gets close to 5%, that could be the catalyst for a quick correction in the S&P and the other markets. But everything, I've said it before, it's momentum and earnings. If you have earnings growth and the momentum's there in the stocks, we go higher. So I think it's set up for a good 2027.
Let's talk about the audience, the advisors. So what do these market and interest rate trends mean for them? How will it affect the way that the ability that they have to serve their clients?
It opens up a lot more opportunities. If you think about, after COVID, when interest rates were down near zero, right? You looked at basically equity only, dividend stocks. There was no yield in money markets, no yield in CDs, no yield in the bond market. Again, going back to what the bond market's doing right now at 4 3/4 on the 10-year Treasury, that gives us corporates in 5.5. More importantly, for the risk adverse clients, that sets up really good for our space. The fixed index annuity. Cap rates are higher, par rates are higher. The FIA is built to be a quasi bond replacement. So if I can get 5% on a corporate bond, the way we build these from an Nexus point of view or innovation design, we're trying to beat that duration, we'll call it 5% by 200 basis points. So we're trying to get 6.5%, 7.5%, 8% on an annualized return. We'll get zero some years, just like the market may pull back 30%. We won't see that 30% drawdown. We're going to have a base of zero on the fixed index annuity. But and higher interest rates means higher income, higher cap, higher participation. And we've sent out a couple white papers. The 60-40 portfolio was definitely dead when interest rates were at zero. But now that interest rates are back, you're probably increase equity allocation. Maybe 60 goes to 70 for a retiree. Maybe 15% goes to fixed income just for living expenses, and the other 15 goes to an FIA, fixed index annuity, for higher returns than that bond market would give you. So the market right now is really good for the advisors to have multiple different options for their clients.
And then income, obviously, I want to talk about Nationwide too, because there's some increased income solutions out there right now, and this is directly related to, interest rates, obviously. But it's funny. We always talk about this before. When interest rates are really high, as we talked about earlier in your conversation, when you're buying property and things like that, not exactly the best situation. But when it comes to these products, right now, they can do things that, in many cases, we haven't seen this before. So, talk about, for example, Nationwide.
Yeah, so Nationwide has a rate increase today. So Nationwide, New Heights, the income rider has been the number one selling income rider. I may be wrong, it's either 6 or 7 years. This will be 7 or 8 this year. And one of the main reasons for that is they don't sacrifice the accumulation side. We never know if we're going to need to trigger the income down the road. But it's always been competitive. It got even more competitive today. So for the advisors, that maybe spreadsheet, looking for the highest penny, so to say, Nationwide got a lot more competitive today. Even if they lose by $100 a month or a year, you probably still buy Nationwide because of the accumulation side of it, legacy, take your income. Maybe there's a death benefit down the road, unlike other income riders. But when you talk about what's out there in the marketplace, we just launched a brand new software with Wealth Builder Cornerstones. It's income specific, specific to the quantum partnerships that we have, whether you're an insurance agent, agency, RA, BD, bank, whatever it may be, and it works in sequence of returns. The way that you should probably look at the income play in the FIA is, what's my core expenses in retirement, right? Let's get the core expenses covered, and then everything else is gravy on top of that. So if I need, on top of Social Security, another $40,000 in guaranteed income, maybe that costs me $250,000 today. Now you can get a little bit more aggressive, or stay allocated to equities, diversify, international, small cap, mid cap, large cap dividends, whatever it may be. So use the income riders that we have, specifically Nationwide, New Heights, inside the FIA, to cover core expenses. And again, if you haven't been on the webinars that we've had, call your VP and ask about our income tool with Wealth Builder Cornerstones. It's unbelievable. Wade Fowle had something to do with it. Wade Fowle is actually going to be here in Scottsdale. We're doing a training in a couple months. Unfortunately, if you're not on the list, it's already sold out. I think we had reservations or commitments within 48 hours. Unbelievable request for turnout. But going back to your original question, how should the advisors be using income? Let's cover core expenses at a minimum, and then from there we can help with the asset allocation, diversification that you may need.
Yeah, for the advisor watching out there who's got a prospect coming in, they're working with a broker or something like that, and all they've ever heard is the 4% rule, and you're looking for $40,000, well, that's $1 million in assets that you need, unless, and I like to play with that Nationwide income calculator, unless you're using something like that, you may only need $550. That gives you $450 liquid, and it's protected, and all these other solutions. That's a good way to sort of differentiate yourself from the current standard, right?
And with the bull market we've had, we just talked about, we think it's going higher. Right. It may not. You never know what's going to happen. Still conflict over in the Middle East. Flip a coin on which day we're going to bomb and not bomb, so to say. But to your point, that calculator that we developed does exactly that. If you're looking at guarantees on the 4% rule, $1 million. To your point, it may only be right now with where rates are. Maybe it's $450,000. That leaves the other $550 to do what you want in the portfolio, right? So buy dividend stocks, allocate to equities on the rotations. We just said Mag 7 looks like it's coming back. If you're not in the Mag 7, buy an ETF, whatever it may be. But you can diversify that way, at least cover core expenses with the income play on the fixed index annuity.
And that handles sequence of returns risk, and everything else is protected. It's lifetime income if you want. You can't beat that. Let's talk about life insurance now. So we have our Life Insurance Summit with ORG, and that's coming up in September. Talk about what we're doing here and why it's important for advisors to pay attention and join it.
Yeah, talk about a partnership that is going a lot better than we would have ever thought. Quantum Life, powered by Org. Those teams are a rock star. Like the advisors that have gone onto the platform, their life production is already probably up 2, 3, 4x, just because of the support that we get. Illustrations are returned, 15 minutes, 30 minutes. If there's some health issues, they're quick to get to underwrite and find the right carrier. We've got multiple advisors and firms on their concierge desk, their outsourced insurance desk. They're taking the apps. Advisors and firms are getting paid. It's been an unbelievable rollout. So what we figured we would do, wait till it cools down a little bit. It was 115 degrees here in Scottsdale over the weekend. But September 29th and 30th, we're going to bring in 40, 50 advisors that want to grow their life business. It's a sales training concepts. We're going to have premium finance conversations. We're going to have business owners, solutions. It'll be a really good event. So we're flying in on Tuesday, happy hour that night. Everyone gets to meet the carriers. 4-hour meeting on Wednesday morning. Go home if you want, stay, play some golf, whatever it's going to be. Seats are limited. We can only handle so much in our Century Room. I know right now we just opened it up last week. We probably got 15, 20 already reserved, so we've got about 30 more spots. But it's unbelievable what we've been able to do with One Resource Group. Great partnership.
Yeah. Would it be safe to say this is a marriage made in heaven? They're as good at life as we are at annuity, right?
Yeah. Ironically, we were just talking about, I was on the conference call with the executive teams this morning, and we're going to expand the partnership. We're going to help them out a little bit. We're really, really good on the annuity, and they're really, really good on the life. So they've got a couple firms that may need some additional help positioning the fixed index annuity with the income plays. They're looking for the software that we have. So the partnership's been really, really beneficial for both sides.
Mm-hmm. And you can see why we call him the Oracle of Scottsdale. That's Andy Moore, Vice President of Advanced Planning and Portfolio Solutions. This is a monthly, sometimes a more regular conversation depending on what markets are doing. And this is something that you can depend on with Quantum. We're here today to talk about things that affect you and your business and your clients. If you want to reach out to Andy, you know where to find him. We're both at Quantum. I'm on the marketing side. He's on the product and advanced planning side. But again, when you think of Quantum, think of us as consultants. But Andy is a person who stays on top of everything that's happening in the markets and in the Fed and in the interest rates, and is a great source of information for you. So take advantage of it, and thanks for watching.